This is a video to overview Chapter 4 exercises. Demo Consulting is a firm owned and operated by Jesse Flatt. The following end-of-period spreadsheet was provided. So we have the unadjusted trial balance, the adjustments that we talked about in Chapter 3, and then the adjusted trial balance. So we are going to make an income statement, a statement of stockholders' equity, and a balance sheet based on the adjusted trial balance. So we're going to start with the income statement. Remember, we put the name of the company, income statement, and for the period ending, so this is a year, August 31st, 20Y9. It also says that there was an additional $15,000 in stock issued during the year. So we should be able to create the income statement. It starts right here on the adjusted trial balance. It starts with fees earned, and then the expenses are listed. We're going to take those and put them in the format of the income statement. So fees earned, and it was $1,480,000. And then we're going to look up here and see what the expenses were. So I'm going to list expenses, and we have salary expense. And the adjusted number is $843,100. We have supplies expense, $22,600. Depreciation expense, $11,800. And we have miscellaneous expense, you can abbreviate, right? $12,500. When we get done with the expenses, we're going to have total expenses. We're going to add this up, right? So $890,000 and net income, right, equals revenue minus expenses. So $590,000 is our net income. After we do the income statement, which we would need to prepare first, we would move on to the statement of stockholders' equity. So on the statement of stockholders' equity, we're going to put the name Demo Consulting, statement of stockholders' equity, and for the year ending. Also remember that we would put, oops, not that, right? We would put the titles here, right? So we have common stock, we have retained earnings, and we have total. These are the columns. We're going to start with the balances, and it's September. We go back a month. We go forward a month and back a year. September 1, 20Y8 would be the beginning of this fiscal year. It goes all the way to August 31st, 20Y9. So common stock. Let's go up here and see what we have for common stock. So common stock has $100,000. Now remember, they told us in the problem, this is our ending balance, $100,000, that they issued $15,000 during the year. So I'm going to take the $100,000 ending balance, I'm going to subtract the $15,000 they issued during the year, and our starting balance for common stock is $85,000. Ending balance minus the issued amount. Then we had a retained earnings. So this retained earnings, we haven't closed out net income to retained earnings, so we're taking the adjusted trial balance number of 810. So 810,000. And remember, the total column, we're just adding common stock and retained earnings across. So 895,000 is the beginning balances for common stock and retained earnings and total stockholders' equity. The next step is we report the issued common stock. So we issued common stock. They told us in the problem that was 15,000. Issued common stock goes in the column of common stock and does not impact retained earnings, right? So that's a 0 in retained earnings. Now, net income has nothing to do with common stock, right? That's just when we issue stock, but it closes out to retained earnings. So we take the number that we calculated in the income statement and we bring it down to the retained earnings. And then again, we add across. And then dividends. So I'm going to go up here, and I believe they had dividends on here. They paid $30,000 in dividends based on the adjusted trial balance. Remember, dividends doesn't impact common stock. It is negative to retained earnings. Dividends are payments from the earnings, right, to the owners. So we would pay that out of retained earnings. So we have a rolling balance of what we earned, right? And we keep adding income to that, net income. If there was a loss, it would subtract. And then we subtract dividends from that. And we continue on. And then we're going to have balances at the end of the year. August 31, 20Y9. So I'm going to draw the lines and I'm going to add down now. We want to know what was the total in common stock at the end of the year. What was the total? I'm going to drag my formula across. What was the total on retained earnings? 810 plus 590 minus 30,000, 1,370,000. What was the total for stockholders' equity? Beginning balance plus the stock plus the net income minus the dividends, 1,470,000. That's also the same as adding common stock and retained earnings together, right? So that is our statement of stockholders' equity. And now we're going to move on to a balance sheet, right? So our balance sheet, as of August 31st, 20Y9, because the balance sheet is only good for one day, right? We're going to start with our assets. Now, if you go up to the top of this, right? And we're talking about the period adjusted balance, right? So if you look, this is listed in the order of the balance sheet. So that makes it very easy for you to prepare. But we're going to break out current assets and current liabilities and plant, property, and equipment because we're doing the expanded balance sheet now, right? So we're going to start with cash. So I'm taking all of these numbers directly from here, except we're going to take our stockholders' equity. So I'm going to move this down in my demo. It's a picture. That's why I made a picture of it, so that we can be right here and look at these numbers. So I'm going to take my assets, and I'm going to start with current assets, right? Current assets. So in current assets, you should have cash, $182,500. I took that right from this picture, right? From the ending trial balance, ending adjusted trial balance. We have accounts receivable, $234,500. And we have supplies. 5,000 is the supplies number. And we are going to get total current assets. And I'm going to go over here and add these up. I'm going to make this, and I'm going to bold the total current assets. Don't worry about formatting. I just care that you put this in the right format. Don't worry about bolding, etc. So after we do total current assets, we're going to do plant, property, and equipment. Plant, property, and equipment. So we're going to have land. That is part of PP and E. We don't depreciate land. Remember, we've been working on depreciation. Land does not depreciate, so we would put it in the second column here. We do have office equipment. So we're going to have to get a net book value for office equipment. We're going to do that by listing the office equipment, which is purchase price was $400,000, right? So I'm taking this from the office equipment line, but we're going to subtract accumulated depreciation. The adjusted trial balance on accumulated depreciation is 72,000. So that's a negative number. Remember, accumulated depreciation is a contra asset. Accumulated depreciation. So it's minus 72,000. Oops. Too many zeros when I'm typing. And we would get net book value equipment. And we would go over here. I'm going to draw a little line here. We add the 400,000 and the negative contra asset of accumulated depreciation, and we would get 328,000. Then we're going to have total PPE, or plant, property, and equipment. So we're going to have a total for the plant, property, and equipment because those are non-current assets. How am I going to get the total? I'm going to add land plus the net book value of the equipment. If there was more than one asset with depreciation, we'd list those and we'd add all the net book values, right? And then we're going to get to total assets, right? So my total assets is my current assets, total current, plus total PPE. So 1,525,000 is total assets. Now we're going to move on. I'm going to drag my little picture down so I can see these numbers. I don't have to keep referring up. And I'm going to move on to liabilities. Now remember I said it's in order, so it's telling me I have liabilities of accounts payable and salaries payable. So 2 here. So we're going to have, they're both current. There's no non-current liabilities. So we have accounts payable, which is 41,500. And I have salaries payable, which is 13,500. So I'm going to have total liabilities. I don't need to say current because there's no non-current. It's just total. So we don't need a separate non-current. And I'm going to add those up. Right? So I have 55,000 as the total liabilities. Now, I'm not going to take my statement of stockholder. I'm not going to take my stockholders' equity accounts from here because we put the net income there. And so we have a different number. So I'm going to go ahead and I'm going to do stockholders equity, right? And I'm going to have common stock, which I'm going to take from above. I'm going to go to the total on my stockholders equity. That's why I need to prepare it in advance. And I'm going to take that number and bring it down. I'm also going to bring down the retained earnings. Retained earnings, 1,370,000. So now I have the retained earnings, and then I'm going to get total stockholders equity. I'm going to add these up. This should also match this total stockholders equity, right? If I scroll back up, it does. And then I'm going to have total liabilities and stockholders equity. This is where our balance sheet should balance. And I'm going to add up the liabilities plus the total stockholders equity, and this should equal total assets. And it does. So I'm going to go drop my picture back at the top for the setup of this problem. But that is your final, I'm going to zoom out, balance sheet right here. So total assets was 1,525,000. Total liabilities and stockholders' equity is the same number. So that is the exercise of making all the three statements, the statement of stockholders' equity, the income statement, and the balance sheet from an adjusted trial balance ending spreadsheet. All right, we're going to move on and we're going to talk about making more statements, right? So this should be a review, but we're expanding the accounts that we have. We're expanding. Let me make this bigger so you can see it when I do this. All right, so let's talk about it. The following revenue and expense balances were taken from the ledger of Acorn Health Services after the accounts have been adjusted on January 1st, 20Y7, right? All right, so we're going to label the statement Acorn Health Service Company income statement January 31st, 20Y7. These are out of order. We're going to have to determine what is revenue and what are expenses. So I'm looking down here. We have depreciation expense, service revenue, that's revenue, right? Insurance expense, miscellaneous expense, supplies expense, utilities expense, rent expense, and wage expense. All right, so we only have one revenue account. So service revenue, that's what we're going to call it, $634,900. And then we're going to list the expenses. So we have wages expense, $548,200. We have rent expense, $60,000. We have utilities expense, $44,700. We have depreciation expense, $10,000. We have insurance expense, $9,000. We have supplies expense, $4,100, and we have miscellaneous expense, $8,150. We're going to have total expenses. We're going to add these all up. And then it looks like we have more expenses than we have revenue. So that would be called a net loss. So we're going to take revenue minus expenses, and we have a loss of $49,250. So they didn't make enough money they didn't make enough revenue to cover their expenses for that month or that year, because it was a year ending. So that's an income statement with a loss. The next problem we're going to do is a statement of stockholders' equity with a net loss. So now we're talking about what if they lose money. All the other examples we've done in class have been them making money, profit. So let's talk about an example of a statement of stockholders' equity if there is a loss. All right, so these are the ending accounts, right? So this is Restoration Arts for the fiscal year end, April 30th, 20Y5. So we're going to have common stock, retained earnings, and total. And then we're going to start with balances, May 1, 20Y4. Okay, so you're going to take the balances in each of these. So common stock had a $10,000 balance. Let me make these all numbers here. Great news. So May 1st, that's the balance. Retained earnings, May 1st is the balance is $475,500. The total, we're just going to add across, right? And then we're going to see what happens. So they issued common stock on July 1st, right? Of $7,500. Remember, that only goes to the common stock line. It has nothing to do with the retained earnings. Now, retained earnings. There is stuff that happened in retained earnings. They had a loss. That's why the 31,200 is over here. There was a loss. So, net loss. A loss is negative to retained earnings. Right? Negative to the total stockholders' equity. Also, looks like what happened here in dividends is they declared dividends and they paid 5,000 worth of dividends. So, dividends is negative to retained earnings, right? So they have a loss and they paid dividends. They were able to pay dividends with the loss because they had previous retained earnings, so they were paying it out of that. Balance is April 30th, 20Y5, and now we're going to add down. Add down. So that is a statement of stockholders' equity with a loss. So the income statement was with a loss. Now we have a statement of stockholders' equity with a loss. The next activity is to prepare a classified balance sheet. So that's what we're doing. We did that in the first problem. We're going to do a little bit more of that work here, right? We're going to make all of these with numbers. So, Dynamic Weight Loss Company offers personal weight reduction consulting services to individuals. After the accounts have been closed on June 30th, 20Y7, at the end of the fiscal year, they had the following balances. Okay, so they're not giving us cash. They want us to solve for cash. But when they give us every other number on a balance sheet, sorry, we'll be able to do that. All right, so I'm going to start with the title. Dynamic Weight Loss Company, balance sheet 20Y7. So we're going to start with assets, right? So we don't know cash, right? I'm going to make this a little larger, following along. So we don't know cash, so we're going to leave that blank for now. But we do know that they have accounts receivable, right? 187,500. We know that they have supplies, 11,200. We know that they have prepaid insurance as an asset, right? We've talked about that. 8,400, and they have prepaid rent. So they prepaid their rent, $6,000. So we'll get total current assets, right? We're going to add these up. We're going to include the line for cash because we're going to come back and solve for that, right? Do they give us total current assets? Yeah. So we'll come back and solve for that. So let's figure this out. Then we're going to have plant, property, and equipment, PPE, which is different from COVID PPE, and equipment. All right. So in our plant, property, and equipment, we have land. Remember, that doesn't depreciate, 375,000. And we have equipment, which does depreciate. The book value on there, so the purchase price of that gross equipment was 325,900, and then we have accumulated depreciation dash equipment, and that is 186 accumulated depreciation. So we're gonna get book value equipment by adding the accumulated depreciation, which is negative, with the equipment, and our book value is 139.9 on this equipment. So now we're gonna get, let me add a T here, total PPE, plant, property, and equipment, We're going to add these two numbers together. And we get 514. And then we would get total assets, right? Which is current assets plus total PPE. All right, now let's go down to liabilities. All right, so our liabilities here. We have current liabilities. Taking from this number, our liabilities are salaries payable and accounts payable and unearned fees. So we have three. So we have accounts payable, 51,200. We have salaries payable, 7,500. And we have unearned fees. Remember, unearned fees is a liability. Revenue collected in advance of performing the service, right? All right, so total liabilities. That's how much we have. And then we have stockholders' equity, right? So we would have common stock, 100,000. We have retained earnings. They gave us to it in the problem. 620,300. And total stockholders' equity. We're going to add this up. 720,300. And we are going to add total liabilities and stockholders' equity. Now, these numbers are not going to balance because we're missing cash. Right? So 800,000. But our total assets are 728,000. So how are we going to find cash? 800,000 is total liabilities minus 728,000. Oops. Equals 800,000 minus 728,000. So cash is $72,000. I solved for cash. And now when I put that in, if you're using formulas, you would go back and you wouldn't need to go back because the formulas would add the 72,000 in cash. And then total assets would equal. So that's how you would solve for cash. And now we're going to work on closing entries. I've talked about closing entries in our overview of chapter 4. Now we're going to talk about closing entries. So we close out income and expenses, non-permanent accounts, and dividends to retained earnings, right? We've been making those happen in the statement. Now we're just going to work on the journal entry. So it says that the automation service company offers companies desiring to use technology to improve their operations. After the accounts have been adjusted at December 31st year end, the following balances were taken from the ledger. So they have fees earned, revenue, dividends, and then they have expenses, rent expense. They have the retained earnings total. They have supplies expense, they have wages expense, and they have miscellaneous. So that, remember, there are two closing entries, right? So one is to close out revenue and expenses. So we have debit, credit, right? So you're going to do the opposite of what they are normally to close them out, because you're going to get to 0. So this is on May 31st. So normally we credit fees earned. To close out, we're going to debit fees earned. Closing entries are opposite of what they normally are. First, you must know what they normally are, right? Then we have wages expense. So normally we debit expenses. Now we're going to credit it. So when we're done, 320,000. Then we're going to credit rent expense, 140,000. Then we're going to do supplies expense, 18,200. Then you're going to do miscellaneous expense, 8,700. And then you're going to do retained earnings. All right, so the retained earnings, right? Remember, journal entries have to balance. All the debits must equal all the credits. So we have 614,500. Retained earnings. You're going to credit retained earnings for net income, which is the difference of fees earned minus all the expenses, right? So fees earned minus all the expenses is what our credit to retained earnings is. This would be net income. And now my journal entry balances down here, right? So that is the journal entry. So we would take, let me do that again. We're going to take fees earned. We're going to subtract all the expenses. And that is the credit to retained earnings. Now, if there was a loss, you would have to debit retained earnings. So if you came up with a negative number, you don't have negative numbers in journal entries, you would change it and it would debit it. And then the second journal entry is to close out dividends. So you debit retained earnings for the amount of the dividend, which was 45,000, and you credit dividends. That way dividends goes away because it's a non-permanent account. And those are your two closing entries. Our final step after we make these closing entries is to prepare a post-closing trial balance. So this means the revenue and expenses would be gone, dividends would be gone, and you just have permanent accounts. Let me go over to this problem. And we're going to make a post-closing trial balance. They gave us the numbers in here, right? So our post-closing trial balance. So we would start with the name of the company, Security Services Company, post-closing trial balance. And we would have debits, balance, and credit balance. And over here we would list the accounts. We're just going to pull the accounts. So we would have cash, 41,100. Make these all dollar signs for you. We would have accounts receivable, 31,317,400. We would have supplies, 5,000. We would have equipment, 162,750. Now accumulated depreciation, on equipment, that would be a credit balance, 733. We would have accounts payable, we would have salaries payable, we would have unearned rent, that's a liability. We would have common stock, and we would have retained earnings. And then what we would do is we would have the total. We would have add up the debit balance and the credit balance. And they should be balanced, right? They should be the same amount. And I'm just going to drag my formula over. and they do balance. So that is a post-closing trial balance. Now you have work to do. It's listed on Moodle what you need to do.